Let's talk more about this story. In fact, joining us right now to do just that is Anat Admati. She is a professor of finance and economics at Stanford Graduate School of Business. Anat is an economist and an advocate for better governance and accountability in the private sector and in government. And that sounds fit exactly for what we're talking about here, Anat. What do you think happened here? You've been watching things like this, dissecting issues like this for a long time.
Well, what happened here is a variation on things we've seen many times before. People take risk with other people's money, borrowing, and then borrowing magnifies the risk. And then it's very sensitive to small moves in whatever they were betting on. And this all was really hidden and obscure. And, there's always some banks involved, and the banks are investing other people's money. And by the way, their leverage is way more than Wang was, but they're, too big to fail.
So what happened? Okay, too big to fail. We think that we fixed too big to fail. We think that we have made sure that the banks have enough capital around to take care of problems like this. Except for that, this doesn't seem to be an issue that's going to break any of them. Obviously, super bad news if you are a shareholder of Credit Suisse or Nomura. But Goldman and Morgan Stanley say that Goldman at least says this is not going to be material to what they've seen.
That's fine. I mean, they're still too big to fail. And just because there's no crisis doesn't mean there's no problem. I mean, when we discovered there's a problem, it was like, oops, we didn't see it coming. And we didn't see this position or that position or the repo 105 in the case of Lehman or whatever it was. So, they have more capital and this is not a big thing. There was London Whale. The thing about these incidents is they show us just how opaque the system remains and just how leveraged. Now, taking on leveraged bet is not necessarily always the most productive investment. Here we have institutions in the middle telling us that they are, making the economy work, but you just have to start wondering when that's what's going on, why the system's so dangerous, so fragile. That's what I wonder about. And it's not like it's going to collapse.
The opacity.
It's just that the opacity is basically saying that there's a lot of risk that we don't know about. Here are these banks that didn't know that what each other were doing. And so they and their regulators are telling us, they have enough capital, risk-based capital, but they don't know what the risk is.
Well, let's go back to that, because the opacity and the lack of disclosures, I think that's certainly fair game and probably something that regulators could and maybe will take a look at some of these issues. But what specifically? I mean, leverage, we knew what leverage was going to be required by the Federal Reserve. When you start coming up with these different contracts, you can get around some of those things. Maybe that's the issue. Maybe it's that. Maybe it's, not following the rules that are on the books. If this hedge fund or family fund was supposed to be filing things and it wasn't, if it was trying to get around the idea that it had 10% in any of these issues, maybe that's the problem. Maybe that's where we should really be paying close attention.
There are multiple issues. One is about sort of the treatment of derivatives and what is considered a position. If it's in the derivatives, it could be sort of equivalent except for definitional things of precisely where the assets, lie in a given moment. But the bet is the bet and it's leveraged. So if it's derivatives, it's treated one way. If it's equity, it's treated another way. So, the notion that something economically equivalent is treated differently for disclosures, especially when you're trying to do risk management of a large, complex company like some of these broker dealers, is problematic. In terms of Archegos itself, yes, something that's really a hedge fund because it doesn't manage other people's money, it manages its own money. That's okay. So then we don't worry as much about people, losing their very own money. However, here they were triggering other people's money impact, and the people who manage these other people's money, meaning all the broker dealers, were themselves certainly big ones with disclosure requirements. And so it becomes an issue of accounting. It becomes an issue of sort of systemic risk to some extent, to the extent everybody was doing the same thing. Still not on a scale of even LTCM and all of that, but enough to kind of show you what might be lurking.
But that's another issue. If you call this a family office, okay. But if you have $20 billion in assets that you're managing, $10 billion, but if it's levered up and it's operating more like $50 billion worth of things that you're moving, I guess there becomes a question of when should that be revealed to regulators to make sure that there's more information to the broader markets about what's really happening.
Exactly. No, exactly right. I mean, it's your initial money, and then it's the leverage you gain through the market, and your overall, therefore, footprint on the market.
Shepard Smith here. Thanks for watching CNBC on YouTube.